If you've ever looked at a balance sheet and immediately closed the document because it looked confusing, you're not alone. Many people see a long list of numbers and accounting terms and assume they need a finance degree to understand it. The good news is that you don't. A balance sheet is actually one of the simplest financial statements to understand once you know what you're looking at. In this video, I'll explain what a balance sheet is, the three main sections that make it up, and a few simple things I look at when trying to understand a business. A balance sheet is simply a snapshot of a company's financial position at a specific point in time. Think of it like taking a photograph. The photograph doesn't tell you what happened last year or what will happen next year. It simply shows where the company stands today. What does the company own? What does the company owe? What belongs to the owners? Those three questions are the foundation of the entire statement. Let's imagine you buy a house. The house is worth $1 million. You paid $200,000 from your own savings and borrowed the remaining $800,000 from the bank through a mortgage. Now let's break this down. The house is something you own. That makes it an asset. The mortgage is money you owe. That makes it a liability. And the $200,000 that belongs to you is your equity. Without realizing it, you've just created your own personal balance sheet. The exact same logic applies to companies. The first section of a balance sheet is assets. Assets are things the company owns or controls that have value. Examples include cash in the bank, inventory waiting to be sold, buildings, equipment, money that customers still owe the company. Assets help the company operate, generate sales, and hopefully earn profits in the future. One useful distinction is between current assets and non-current assets. Current assets are expected to be used, sold, or converted into cash within the next year. Cash, inventory, and receivables are common examples. Non-current assets are expected to remain with the business for longer periods. Things like factories, offices, and equipment typically fall into this category. The second section is liabilities. Liabilities represent obligations that the company owes to others. Common examples include bank loans, supplier invoices, taxes payable, bonds, and other borrowings. Just like assets, liabilities are often divided into current and non-current categories. Current liabilities are generally due within the next year. Non-current liabilities are expected to be repaid over longer periods. Understanding liabilities helps us understand how much financial obligation the business is carrying. The third section is equity. Equity is often the easiest section to understand once you've seen the house example. It represents what is left after liabilities are deducted from assets. If a company owns $100 million of assets and owes $60 million, the remaining $40 million belongs to the shareholders. That remaining amount is equity. A simple way to think about equity is ownership. It's the shareholders' share of the business after all obligations have been considered. Every balance sheet follows the same basic equation. Assets equals liabilities plus equity. This equation must always balance. That's why it's called a balance sheet. Everything the company owns has been funded either by borrowing money or by money provided by shareholders. Once you understand this relationship, the statement becomes much easier to read. When I first open a balance sheet, I don't look at every line item. I usually start with three simple questions. First, how much cash does the company have? Second, how much debt does the company have? And third, does the company appear financially comfortable or financially stretched? These simple questions often tell you more than dozens of complicated ratios. A few things may deserve closer attention. Very high debt, very low cash, negative equity, or a situation where the company has a lot of bills due soon, but not enough cash or other short-term assets to cover them. None of these automatically mean a business is bad, but they are usually worth investigating further. If you remember only one thing from this video, remember this. A balance sheet is simply a snapshot of what a company owns, what it owes, and what belongs to the owners. That's it. Once you understand assets, liabilities, and equity, you've already understood the foundation of every balance sheet you'll ever read. And the next time you open a set of financial statements, you'll hopefully feel a little less lost.